The mortgage payment hasn't changed in years, but the number withdrawn from the checking account every month keeps inching higher. The escrow notice arrives in late summer, folded into a standard white envelope that looks identical to the others that have come before it. The homeowner opens it at the kitchen counter before leaving for work, skimming the bolded line that states the new projected monthly payment. The principal and interest remain the same. The difference is in the lower half of the page, where property taxes and homeowners insurance are recalculated for the coming year. When the house was purchased 12 years earlier, the total monthly payment felt stable. It was a fixed rate mortgage, 30 years, carefully chosen after weeks of comparison. The predictability was part of the appeal. The loan officer had described it as steady and manageable. The payment would not change. That was the phrase that settled the nerves. For the first few years, that appeared to be true. The escrow portion moved slightly, an adjustment of $40 one year, then a modest refund the next. But nothing that altered the overall structure of the household budget. The homeowners, both in their early 40s at the time, were dual income earners with two children in elementary school. Salaries were rising slowly. Bonuses were modest but consistent. The mortgage line item sat quietly among utilities, groceries, car payments, and childcare. By year 6, the tax assessment had crept upward in a way that felt incremental but steady. The neighborhood had improved. A new retail corridor had been built nearby. Home values were climbing. The increase in assessed value was framed as positive news. The equity statement reflected growth. Online valuation tools showed encouraging numbers. The homeowners felt affirmed in their decision. The tax bill did not feel like affirmation. The county reassessment pushed the annual property tax higher by several $100s. It was not catastrophic. Spread across 12 months, it translated into an additional $78 per month in escrow. It blended into the overall expense structure. The family adjusted by trimming discretionary spending, fewer dinners out, postponing a small vacation. Insurance remained stable until a series of regional storms altered underwriting models. The home was not in a floodplain. It had never filed a claim. Yet, premiums across the state rose in response to broader risk patterns. Reinsurance costs increased. Carriers recalibrated exposure. The renewal letter cited market conditions. The premium jumped by 23% in a single cycle. The monthly escrow recalculation followed. The mortgage statement no longer resembled the original amortization schedule the couple had studied years earlier. The principal and interest remained unchanged, but the total monthly payment had climbed by nearly $400 since the purchase date. There had been no renovation, no cash-out refinance, no second lien. The house itself was structurally the same. The homeowners began referring to the mortgage as fixed, though it no longer behaved that way in practical terms. At work, annual raises average 3%. Healthcare contributions through the employer plan rose in parallel. Retirement contributions remained consistent at 10% of gross income. College savings deposits continued automatically each month. Nothing dramatic shifted, yet the margin between income and fixed expenses narrowed. In the 10th year of ownership, the property tax assessment increased again, following another county-wide valuation update. Comparable homes in the area were selling for substantially more than they had a decade earlier. Real estate headlines framed it as a sign of strength. The homeowners saw their estimated equity rise on paper. The tax bill rose with it. The couple attended a local informational meeting hosted by the county assessor's office. Charts were displayed explaining municipal budget needs, school funding allocations, infrastructure maintenance. The increases were presented as necessary and proportional. The homeowners understood the reasoning. They signed no petitions. They filed no appeals. They absorbed the adjustment. Insurance shifted again after a national carrier exited certain zip codes considered higher volatility. Their policy was non-renewed. The replacement policy carried a higher deductible and a premium that was 18% above the previous rate. Coverage terms were more restrictive. The change was framed as a market response to weather trends and construction costs. The mortgage servicer recalculated escrow for the third consecutive year with a significant upward revision. At dinner, the couple reviewed their budget spreadsheet. The column labeled housing now represented a materially larger share of take-home pay than it had at purchase. Not because of borrowing decisions, but because of cumulative peripheral increases. They had refinanced once during a low-rate period to reduce the interest rate. The refinance lowered principal and interest by $200 per month. For a brief period, the total payment felt lighter. Within 3 years, property tax and insurance increases had offset nearly all of that relief. The house appreciated steadily. Zestimate style estimates displayed gains exceeding $200,000 since purchase. Yet the equity remained theoretical. Selling would require buying into the same elevated market. Moving would not eliminate exposure to property tax escalation. It would reset it. In year 12, the older child entered college. Tuition payments began to overlap with the ongoing mortgage obligation. The homeowners were now in their mid-50s. Retirement projections indicated adequacy but not excess. They had anticipated that housing costs would become relatively smaller as income rose and the mortgage aged. Instead, housing had become structurally heavier. A detailed review of historical statements revealed the pattern. The original monthly payment had been $2,150. 12 years later, it stood at $2,670. Principal and interest remained fixed at $1,680. The rest reflected tax and insurance. No single increase had felt destabilizing. Each adjustment arrived as a modest change justified by external conditions: rising property values, school district budgets, regional risk pools, replacement cost inflation. In aggregate, the increases amounted to more than $6,000 annually beyond the original projection. The amortization schedule showed declining interest over time. Equity built predictably. Yet, cash flow pressure moved in the opposite direction. Colleagues at work described similar experiences. One coworker in a neighboring county had seen insurance double within 5 years following wildfire exposure in the broader state. Another had moved to a suburban district with lower taxes only to watch reassessments gradually close the gap. The language varied, but the structure was similar. The mortgage was fixed, the housing cost was not. By the 15th year of ownership, maintenance costs began to layer in more visibly. A new roof was installed after hail damage. Insurance covered part of it, but the deductible was substantial. The following renewal cycle reflected the claim history. Premiums adjusted again. Property taxes continued their upward progression, linked to assessed value increases and municipal levies approved through local ballots. Voters in the district, including the homeowners themselves, had supported school bonds and infrastructure funding measures over the years. The civic logic was clear. The financial result was cumulative. The couple's income peaked in their late 50s. Promotion stabilized. Wage growth slowed. Meanwhile, escrow recalculations continued annually. They paid off their car loans. Childcare expenses disappeared. College tuition concluded. Yet, the housing line item did not retreat. It had developed its own momentum, detached from the original financing decision. The mortgage balance fell below 50% of the original purchase price. Equity was substantial. Net worth statements reflected progress. Financial advisor software displayed improving ratios. But the monthly withdrawal from the checking account remained persistently elevated. In conversations with peers contemplating early retirement, the homeowners found that housing cost assumptions were often anchored to the idea of a fixed mortgage payment. The reality, reflected in their statements, was more fluid. Property tax assessments did not plateau simply because the homeowner aged. Insurance premiums did not freeze once claims were absent for a period. Replacement cost inflation operated independently of personal income trends. In year 18, the county conducted another reassessment. Market appreciation had accelerated following broader housing supply constraints. The homeowner's assessed value increased significantly. The tax bill followed accordingly. The new escrow calculation pushed the total monthly housing payment above $3,000 for the first time. There was no celebration attached to the equity milestone. The homeowners did not feel wealthier in daily life. They felt constrained by the recurring obligation. Downsizing was discussed. Yet smaller homes in the same district carried similar property tax exposure due to current market pricing. Moving out of state would introduce other variables: income tax differences, climate risk exposure, insurance availability. The mortgage balance continued to decline predictably, each statement showing incremental progress towards zero. But the housing cost structure had transformed into something less predictable over the long term. Friends who had paid off their mortgages described a different version of the same pattern. Once principal and interest disappeared, property taxes and insurance remained. The total outlay dropped, but not to zero. In some cases, the combined tax and insurance burden exceeded what their original principal and interest payment had been decades earlier. The homeowners began to recognize that the concept of owning outright carried ongoing obligations that were not temporary. As retirement approached, the couple modeled their fixed income projections against historical property tax growth rates in their county. The chart showed steady upward drift. Insurance premiums had demonstrated greater volatility, with sharper jumps following regional events. They had not over-leveraged. They had chosen a conservative mortgage. They had avoided adjustable rate structures. They had maintained consistent employment and savings habits. Yet, the cumulative escalation of property taxes and insurance had altered the long-term housing cost profile in ways that were not visible at purchase. In the 21st year of ownership, the mortgage balance dropped below $100,000. The end of the loan term felt closer. The original purchase paperwork, stored in a file cabinet, seemed dated and almost quaint compared to the current financial environment. The escrow notice arrived again that summer. The projected monthly payment increased by another $92. The principal portion of the payment would decline the following month as scheduled. The escrow portion would rise. At the kitchen counter, in the same house purchased more than 2 decades earlier, the homeowners reviewed the updated figures. The house was familiar. The neighborhood had matured. The children were adults. The mortgage was nearing completion. The housing cost had never remained still. They folded the notice and placed it in the drawer with previous statements, part of a quiet archive of incremental adjustments that, over time, had reshaped the financial architecture of the household. The structure had appeared fixed. The obligations surrounding it had not. The checking account would reflect the new amount next month, as it had every year before. And the house would remain exactly where it stood, unchanged in form, carrying a cost that continued to evolve.